Good afternoon, and it's great to see so many of you here today in Singapore. I'm actually based in Tokyo. I've been in Tokyo for about 11 years now, and so the presentation today is going to be focused around, I'm not originally from Tokyo, obviously, so it's going to be around what I see changing in Japan during the time that I've been there. Probably the question that's on everyone's lips at the moment, which is, where do we go from here? Obviously, 2023 has been the year that put Japanese equities, I think, back on the not just the travel map, but also maybe the asset allocation map as well for many people here. And I'm sure it's been a very successful year. So I'll be talking about our view going forward on Japanese equities, and within that, try to make a bit of a case for small caps. So last year was very much, I think, the year of the large cap with the Warren Buffett type plays, financials. You had the auto sector, performing very well as supply chain disruption in 2022 kind of fell out of the picture. Strong earnings comps. Small caps kind of got left behind, but I think there's actually a strong possibility that we'll see small cap EPS growth actually overtake large cap in 2024. And there's a couple of really interesting points I'm going to make to kind of set that message home. So on the first slide, I just want to kind of recap the long-term performance trend of Japanese equities. So on this chart, the light yellow line, which is just below that dark blue line, these are the Japanese equity indices. The yellow one is the large cap, and the blue one is the mid and small cap. So the message here is many people believe that the Japanese equity, strong performance just began last year. In actual fact, if you look at, this is local currency return in yen, the performance of the equity markets is actually just behind the US over this 10-year period. So, and this has all been driven by substantially EPS growth and not valuation expansion. Valuations have actually contracted. So I think that the market is potentially more attractive than ever in terms of valuations. As far as what I see changing in Japan, I think the most important thing that's changing is a shift from a country of accumulation, essentially, towards a country of investment. And this is symbolized by, essentially, CapEx in the private sector. So the chart on the screen shows the CapEx as a portion of nominal GDP, and on the left-hand side is the Nikkei index, the equity market. This chart goes all the way back to 1980. So at the end of the 80s, Japan essentially experienced the bubble economy bursting, and the stock market, as well as CapEx, really fell off and never recovered until 2010. So the question is, we now see a recovery over the past 10 years. But as this CapEx increases, I think the question on many investors' lips is, won't the same thing happen? Isn't it just another bubble? Well, we can look at, for example, the price-to-earnings ratio of the market back in 1990. It was about 60 to 70 times, 60 to 70. Now it's around 14, and that is towards the bottom of the 10-year range. EPS growth is strong in Japan, and it's backed by improving margins as well. So if we look at the profitability of Japanese companies, it's been improving sustainably over the past, again, 10 years, and this is what's been driving the market performance. So that is a quick look back. Something that I think is really interesting at the moment is foreign direct investment is increasing in Japan. Many of you will have heard of the Taiwan semiconductor company, TSMC, essentially is now building 3 plants in Japan. One of them is almost completed, and the other 2 are set to be built going forward, primarily in the Kyushu area of Japan, in the south of Japan, which is now actually in Japan known as kind of the Silicon Island. So it's the southernmost island, and it's very much, I would say, a hotbed of semiconductor activity. So Japan lost its crown, essentially, in semiconductor manufacturing back in the 80s, and it never recovered it. And now we're seeing CapEx moving in to attempt to return to the leading edge in terms of chip production. So we have TSMC in the south of Japan. We also have Rapidus, which is a Japanese joint venture in the north of Japan. They're intending to manufacture 2 nanometer chips, so real leading edge. And I believe that this really shows how the shift from accumulation, and the capital stock in Japan is immense. On the private sector, it's about 1 times GDP that companies have on their balance sheets in cash. And on the household sector, it's about 3 times GDP. So there's capital stock, it's now being deployed. And we believe that the CapEx boom is going to continue to sustain the equity market performance. So why then would you want to invest in small caps? Wouldn't it be better to invest in the well-known names such as TSMC, building the plants, such as Sony, etc.? Well, there's actually 2 points I want to make here. And the first one is everyone knows about those names. So essentially, the performance is already being priced in. Where we see in the small and mid-cap space, and Japan, the reason that TSMC chose Japan in the first place is because of the strength that the country has in the essentially semiconductor production equipment as well as the materials side. And that is primarily dominated by small cap companies, especially in the upstream, many of which trade at, I would say, very reasonable valuations. So one opportunity where we see even more potentially attractive plays in terms of investing in small and mid-cap companies is actually looking at the type of companies that are not currently directly involved with that value chain, but that have strong market share domestically, that have proprietary technology, that have competitive advantages, and have products that could be adapted into different uses going forward. Something else I noticed about Japan is that the quality, job creation. We've actually seen many investors are concerned that Japan is an aging society. We do have a labor shortage, certainly issue in Japan. It's actually an opportunity, I think, especially for small cap investors, when we look at the companies in the services sector, for example, human resources, retraining, companies that cater to these type of needs, as well as digitalization. So companies that are helping companies in Japan to increase their productivity to offset the labor shortage. But one thing I've noticed in my time here is that the number of individuals with kind of full-time jobs has grown substantially over the past 10 years. This is really due to, I think, the women entering the labor force and also a move towards full-time employment as opposed to part-time. So there's quality employment now, and I think this is actually one aspect that's driving the investment side in terms of households. So households are also increasingly moving their cash to riskier assets, to equities, etc. And I think that is going to be an important driver in the stock market as well going forward. It's part of what I would call the great wealth transfer as well. So the majority of the household wealth in Japan is actually in cash. So households in total have 14 trillion US dollars, and half of that is actually in cash, in yen cash. So that's earning no return. As we go forward, we see moderate inflation. There's going to be more incentive for individuals to invest these assets, and we think that Japanese equities will benefit from this tailwind as well going forward. In 2024, there's something quite exciting going on in Japan in terms of asset formation for individuals. We have a new type of tax efficient account, and we expect that going forward, it's a significant expansion of the scheme, essentially. So individuals can now invest 9 times more money than they could tax-free than before. The total capacity of the scheme is actually enough to cover all of the cash assets in Japan. So we think that it could have similar effect to what the US 401k pension scheme had in the early 80s. So I want to move on now, just finishing up looking at Japan as a broad market there. So why would we invest in small caps? Well, I think that there are two angles, each of which very distinct, and each of which can be, I think, we can take very interesting exposure for our portfolios too. And we've listed kind of on the screen here. I think you can, by buying small cap companies in Japan, you can build concentrated exposure to the unique growth potential within Japan. This is areas like, for example, digital transformation. Many of the companies that are trying to modernize their systems, for example, in the banking industry, they're relying on small cap systems integrators, on providers, etc. And earnings of these firms have actually accelerated much faster than large cap software companies, particularly in the third to fourth quarter of last year. And the share prices are reflecting that as well. So digitalization and playing that through small and mid caps is one area that I think is really interesting. The other part is, of course, the supply chain restructuring story. So that really does play into what I was talking about with TSMC, whereby as these new semiconductor plants are built, they actually create regional economies. So they create need for employment, they create need for maintenance, need for construction, etc. All these opportunities, and again, small caps who have more direct domestic revenue exposure, we expect their share prices to reflect the changes in earnings much more strongly than, say, large cap companies which have a large diversified pool of businesses, many of which, with no, I would say, connection to that specific revenue driver. So through small cap investing, we can build, I would say, concentrated exposure to particular drivers and growth drivers going forward. So that's the Japan story. But also on a global basis, Japan has very unique strength in terms of, as I mentioned earlier, the upstream, particularly semiconductor materials. So if we talk about specialized gases, things like chemical, the raw components for semiconductors, etc. And these companies are not bid up to the levels that we see that, the generative AI directly related companies are. In many cases, they are ignored completely for many years. And we actually have an example in the portfolio that I can talk to you about. If you're interested in that, I'll be at the booth, the BNP Paribas booth, later on. So I think, just to finish up, I want to talk a little bit about, our fund's approach to small cap investing. Because the thing is, with the small cap universe in Japan, it is over 3,500 companies. And many of them, or obviously they don't have these growth drivers, they don't have these unique aspects that we want in our portfolio. They're more, I would say, many of them in the pharmaceuticals, industry, many of them in retail, etc. Not fast-growing areas. So we try with the fund to invest specifically in, as I mentioned, that hardware tech, software tech. We try to do it with companies very reasonable in terms of valuations. We don't, chase expectations. So our style is actually a value to growth type investment style. I think it's a really unique style in the market, and maybe could only be possible in a country like Japan, where there is the breadth of companies to look at, as well as the lack of analyst coverage in terms of the mispricing of consensus. So in the long term, we've been managing the BNP Paribas fund since 2013, and you can see that we've delivered strong outperformance versus both the Topics Index, which is the kind of the broad large cap dominated Japanese equity index, as well as the benchmark of the fund, which is the small and mid cap index. And we have some other slides on performance as well, if you'd like to see them later. So if you look as well at the calendar performance, I think it's been very consistent. 2022 was an extremely challenging year, particularly for, I would say, coming off the strong year of 2021 for hardware tech, given the faster and higher kind of rate regime, etc., as well as a preference for kind of lower quality, so-called value type plays in the market. We're actually ahead of the benchmark coming into the end of 2023, and as I said, I'm really optimistic about the fund going forward into 2024. Three things really. The one is the EPS growth of small caps is likely to overtake large caps. The weak yen that existed throughout 2023, as we see the rate hike cycle come to a close, that may fade. That's mainly a tailwind for large caps with global business exposure. Less so for small caps, particularly in the services sectors, etc., within the Japanese economy. So we're quite, I think we think that's going to be quite interesting as well going forward. The final one is just the multiple contraction aspect that we saw in 2022 through the rising rates and into 2023. That has really, I think, played its course in 2023. And in the second half of the year, we actually outperformed. We finished the year with up about 3% versus the index. So finally, just only 1 minute left. I'll give you a quick intro to the team. So we have an all-local Japanese investment team based in Tokyo. We have an extremely experienced lead fund manager who, and the team between them, they hold over 900 research visits with companies in any particular calendar year. They're dedicated to this team, and they're also backed up by, again, an all-local Japanese equities analyst team, as well as an irresponsible investment section as well. So I spoke a little about the process, the value to growth aspect. If you want to hear more about that, come and see me in the booth. But this is really an overview on the screen. And also I'll talk about what kind of we hold in the portfolio as well. So just to finish up, these are the three kind of points, the takeaways that I want you to think about at the end of the presentation. So we believe that boosted by primarily capex and consumption as real wages recover, 2024 is likely to be another strong year for the equity market. Small caps are poised to outperform for the reasons that I kind of went through in the presentation. And we believe that our approach, not of investing in a broad market base of small cap companies, including low growth companies, etc., but rather trying to find those companies that in the future could be related to the EV value chain, the AI value chain, clean energy, etc., is the way to approach the small cap space. Thank you very much for listening today.